Welcome back to the Pro Ticker Podcast, your Tuesday morning edition covering major financial magazine headlines, everyone. We have compiled quite a stack of sources today, really fascinating stuff that, well, it underscores just how interconnected everything is and frankly how volatile the global economy feels right now. We're looking at everything from, tiny memory chips and the scramble for raw materials all the way up to high-level political shifts affecting huge bond markets. Okay, so let's try and unpack this. The mission for this deep dive really is to connect three big interlocking global storylines. First, how this massive AI boom is tightening supply in corners of the tech market you might not expect. Second, how global powers are really scrambling to secure the raw materials they need for, well, the future, EVs, defense, chips, you name it. And finally, how major financial markets are dealing with all this political instability and, maybe most importantly, a real lack of reliable economic data right now.
It's an environment defined by just extreme interconnectedness. And you, the listener, really need to grasp how a strategic shift in one area, like, say, pouring billions into AI, can immediately ripple out. It creates these chaotic supply crunches in completely different established sectors. Think consumer electronics. We're definitely seeing a global theme here. Scarcity is driving competition, both, economically and geopolitically.
And that theme kicks off right away in the semiconductor world, doesn't it? Let's dive into what the AI boom is actually doing to that supply chain. You'd think naturally all the action, all the drama is around those super powerful cutting-edge AI processors themselves. But the really surprising finding, based on the Reuters analysis we've looked at, is that the huge demand for specialized high-bandwidth memory HBM is actually squeezing the supply of the much less glamorous workhorse chips, like traditional DRAM.
Exactly. Let me break that down a bit for you. HBM, that's the high-speed specialized memory built to feed those massive AI chips, right? DRAM is the standard stuff.
Yeah.
Dynamic random access memory. It goes into basically every smartphone, every PC, every regular server out there. So after the whole generative AI craze really took off, late 2022, manufacturers like South Korea's Samsung and SK Hynix,
The big ones?
yeah, the giants, they control something like 70% of the global DRAM market. They decided to shift their manufacturing focus. They started reallocating production lines, moving capacity away from standard DRAM and towards the much higher margin AI-focused HBM.
Higher profits there, presumably.
Definitely driven by the AI gold rush, sure, but also partly by rising competition in that lower-end commodity chip space, especially from Chinese rivals like CXMT.
And the market reaction, pure panic, it sounds like.
Pretty much.
Toby Gonerman from Fusion Worldwide, that's a semiconductor distributor, he noted the demand surge for the suddenly harder to get commodity chips has just been fast and furious.
Mm-hmm.
He described widespread panic buying,
Yeah.
even double or triple ordering as companies desperately tried to lock down inventory.
And the numbers really show the chaos. Average inventory for those commodity DRAM chips, it just plummeted. Think about this. Early 2023, inventories were comfortable, around 31 weeks worth. Now, this quarter, just 8 weeks.
Wow, that's a huge drop.
It's massive. And when supply vanishes that quickly, prices don't just creep up, they explode. The average selling price on DDR5 server modules, that's the standard, next-gen memory for corporate servers, is, as Reuters put it, going through the roof.
Well, I guess that price shock is music to the ears of the memory chip makers, right? Even though they shifted focus to HBM, commodity DRAMs are actually seeing this counterintuitive profit surge now.
It's fascinating, isn't it? KB Securities estimates Samsung's operating margin for commodity DRAM was already pretty good, around 40% in Q3. Now, yeah, that's still lower than the margins on HBM, maybe 60%. But analysts are now projecting that non-HBM profitability could actually beat HBM next year if these prices keep soaring.
So that creates a weird dilemma for them, doesn't it? If the boring chips suddenly become more profitable because they're scarce.
They shift back, exactly. It's a real strategic puzzle. Markets sending these conflicting signals about where the best returns really are.
And for you, the listener, and for companies making the hardware, what does this volatility mean?
Well, it means serious margin pressure.
Yeah, we saw that British PC maker Raspberry Pi had to announce price increases. They specifically pointed to memory costs up roughly 120% from just a year ago.
Oh.
That's a huge cost being passed down the chain, directly impacting the final product price. And we shouldn't forget the geopolitical layer here. This whole crunch is happening while China's main memory chip maker, CXMT, is planning this huge Shanghai IPO, Could be valued up to, what, $42 billion, maybe early next year?
That's the target. It's a very determined push by China to gain ground in both DRAM and HBM production. And it's crucial for them, especially after the U.S. restricted their access to advanced HBM technology last December.
Okay, so that chip supply crunch links perfectly to our next theme, the scarcity of the basic building blocks.
Right. The fundamental materials needed to build, well, everything important. We're talking rare earths, those critical minerals essential for EVs, wind turbines, defense tech, and yes, semiconductors too. It raises this really important question. If silicon access is tight, what about the actual raw earth elements? And what happens when that supply isn't just tight, but potentially weaponized?
Which brings us straight to that U.S.-Australia countermove. Just yesterday, President Trump and Australian PM Albanese signed this $8.5 billion critical minerals framework deal. And the aim seems pretty clear. Boost supplies outside of China and start to, well, chip away at China's dominance in this area.
Mm-hmm.
They've even named specific projects like Alcoa getting help with gallium recovery, flagged for potential U.S. equity investment. And they're talking about trying to set up some kind of rare earths pricing framework.
Yeah, but the sheer scale of the challenge facing that $8.5 billion initiative is immense. You have to understand the reality of China's current control.
Mm-hmm.
The International Energy Agency estimates China controls something like 70% of actual rare earth mining,
Okay.
then 85% of the refining capacity.
85%.
And it may be the most critical part. A staggering 90% of the world's production of permanent magnets. Those are absolutely vital for electric vehicle motors and lots of defense applications.
90%, wow.
So China's Ministry of Foreign Affairs responded to the U.S.-Australia deal pretty diplomatically. They said, resource-rich countries should play a proactive role in stabilizing supply chains.
Which sounds like code for.
Basically, code for let the market decide, implying that state-led subsidies shouldn't distort things. They feel they have the market advantage.
So how did the market react? That Australian stock reaction seems telling. Critical metals companies jumped initially on the news, right?
But then they fell back pretty quickly, many of them. Lynas, a major player, fell over 7%.
Does that suggest the market thinks $8.5 billion just isn't enough? Or maybe that processing this stuff outside China just isn't economical without massive ongoing government help?
I think it's profound skepticism about the long-term viability without subsidies. It's expensive to mine and refine these materials. It's often environmentally messy. China built its dominance over decades with state support. So investors are cautious. They know that until the basic economics change, government money is pretty much the only thing keeping these alternative supply chains going.
And meanwhile, the immediate threat for industries using these materials. It sounds terrifying.
It really is.
Global automakers are apparently scrambling to stockpile rare earths right now. Why? Because China's new export controls are set to kick in November 8th.
Yep, that deadline is looming.
The stakes seem incredibly high. We saw a quote in our sources from Toyota's North America VP of Purchasing, Ryan Grimm. He said, pretty bluntly, China can shut us down in 2 months, the entire auto industry.
That's a stark warning.
Yeah, and supplies are already super tight. Another supplier executive mentioned their magnet inventories have already been depleted.
Car makers like GM, BMW, Renault, they're working on developing motors that use fewer or zero rare earths. That's the long-term fix.
Yeah.
But those solutions are, by all accounts, years away. So right now, the global race for the future EVs, green tech is hitting this major raw material bottleneck, and it's all tangled up in geopolitics.
Okay, so if we follow this thread of scarcity, competition, and geopolitical tension, let's shift to the broader macro picture, the political and data uncertainties hitting financial markets.
Yeah.
And what's really striking here is the data vacuum, especially for the U.S. Federal Reserve.
Indeed. The Fed has its policy meeting next week, a crucial one. But their view of what's actually happening in the economy is seriously obscured. Why? Because the U.S. government shutdown is still ongoing. It's actually the third longest in history now. And it's suspended the release of key economic reports, labor data, consumer spending, housing stats.
So Fed is basically flying blind, as economists are saying.
Pretty much. And what's the risk there? Well, even though financial markets still mostly expect the Fed to cut interest rates by a quarter point.
Right, that's the bet.
The policymakers themselves are apparently divided. They're forced to rely on, state-level data, private surveys, things that just aren't as comprehensive or calibrated as the sources noted compared to the detailed government stats they usually have.
The danger is they make a mistake, right? A policy error.
Exactly. Without a clear picture of inflation trends or how much the labor market is really cooling, the Fed could cut too much, maybe reigniting inflation. Or they could wait too long, tightening policy too much and choking off economic growth.
It's a tough spot. Is there any key data coming out?
Well, the one big one, the September Consumer Price Index, the CPI inflation report, is finally confirmed for release this Friday, October 24th, after being delayed. You can bet policymakers are pinning a lot on that single number.
Keeping nerve-wracking.
Yeah. Fed Governor Waller himself highlighted the difficulty. He talked about the economy's bifurcation, where wealthier folks are still spending, but lower income households are really struggling with credit costs and inflation. It's just hard to read the overall picture when the experience is so split.
And we're seeing major political uncertainty causing friction elsewhere, too, right?
Yeah.
Across the Pacific, in Japan.
Absolutely. Japan just experienced a pretty significant political shift. Sanae Takaichi won the parliamentary vote. She's now Japan's first woman prime minister.
And she's known as a hardline conservative, an apostle of Abenomics.
That's the label. It means she generally favors the policies of former PM Abe aggressive fiscal stimulus government spending.
And her rise is causing jitters in the markets.
Oh, yeah. Fears about big government spending, potential fiscal largesse. It's fueling a comeback for that famous or infamous widowmaker trade.
But explain the widowmaker for listeners again.
Sure, it's Wall Street slang for betting against Japanese government bonds, basically short-selling JGBs. It got that name because historically the Bank of Japan has jumped in so aggressively, often unpredictably, to keep bond yields super low.
That huge hedge funds, big players, have lost fortunes trying to fight the BOJ.
Exactly. It's a trade known for crushing fortunes. And now it's back. Well, investors are worried that Takeichi's spending plans will put huge upward pressure on Japan's long-term borrowing costs on those bond yields. JGBs have already been the worst performers in global government bond markets this year. They've lost over 4% of their value. So the short sellers are betting that even the powerful Bank of Japan can't hold yields down forever against this political instability and spending pressure.
Fascinating. Okay, one last area. Let's look at this stark contrast playing out in San Francisco. The huge AI investment boom versus the national political narrative around the city.
Yeah, it's quite a contrast. The sources paint a picture of San Francisco undergoing this massive AI-driven resurgence, really bouncing back post-pandemic. The numbers are pretty staggering. Venture capital funding in the Bay Area for 2025 expected to beat the record high from 2021, potentially hitting over $276 billion.
Wow. And a huge chunk of that is AI, right?
A massive chunk, like $115 billion specifically targeting AI VC funding just in that region. 80% of all AI VC money, basically.
And the local picture seems to support this comeback narrative.
It does. The city's chief economist was quoted saying, "San Francisco seems cleaner and safer now than it's ever been," citing city data showing crime rates down 30% from last year, homicide levels the lowest in 70 years.
Okay, so you have this intense local economic boom, improving city metrics.
Right. But it's constantly clashing with this national political friction. President Trump keeps repeating calls to deploy the National Guard to the city.
Despite the data showing improvement and local pushback.
Yeah. And Salesforce CEO Mark Benioff, who hosts the huge Dreamforce conference there, he had initially seemed open to the idea last week, but then publicly walked back his support after pretty sharp criticism from local officials.
Yeah.
They argued, the Guard isn't trained or authorized for local policing.
So quite a whirlwind tour there. We've tracked the money and the pressure points from those DRAM chip margins and Samsung's unexpected profit boost, all the way to the shaky stock prices of Australian mineral companies, the Fed trying to navigate with no data, and this political drama swirling around Tokyo and San Francisco's AI boom.
The central tension here, for you, the learner, is this. The global economy is riding this absolutely unprecedented AI wave, right? Which generates massive optimism, huge investment. But at the same time, it's grappling with these severe, often short-term supply constraints, intense political risks. It creates what some might call rational bubbles. Knowledge is power, as they say. But what today's sources really show us is just how many crucial decision makers, from central bankers to car company execs, are operating with huge blind spots right now. Blind spots caused by, murky supply chains, geopolitical friction, governments not releasing basic data. It just means critical thinking, putting the pieces together yourself, is more essential than ever.
Okay, that leaves us with this final provocative thought for you to chew on. We've clearly established how the AI investment boom is, kind of ironically, choking the supply chain for physical memory chips. But we also touched on how AI, according to companies like Lovable, might be dramatically lowering the barrier to entry for software development, this idea of vibe coding. So if this democratization of technical skill keeps going, if it potentially unleashes a wave of new entrepreneurship, especially in emerging markets, will the value created inevitably flow back to the established tech hubs like San Francisco anyway, because of the need for infrastructure for capital? Or could this finally be the catalyst, the thing that allows entrepreneurs in emerging markets to really build and scale truly disruptive, homegrown, local solutions? Will the value stay local this time?
It's a big question.
It is. Something worth considering as you watch the markets today. We'll see you all tomorrow morning with new headlines from major financial magazines.